Here is a number you have probably seen in a headline. India's formal lending system, all its banks and financial institutions combined, equals just 57% of what the entire economy produces in a year. To be precise, this is not about spending. It measures the total pile of outstanding formal loans, every home loan, business loan, personal loan, currently being repaid compared to 1 year of economic output. The US pile stands at 214%, China at 185%, Vietnam at 126%. India's pile is smaller, not because Indians do not spend or borrow, but because for most of history, formal credit reached only a narrow slice of the population. The media calls this a deficit. For investors, it is a runway. But the real story is more nuanced than either framing suggests. India is not a country without credit. It never was. According to NABARD Rural Sentiment Survey of September 2025, India's most comprehensive rural finance study, roughly 22% of rural households still borrow exclusively from informal sources. Another 24% use a mix of both formal and informal credit. These people are already borrowing from moneylenders, chit funds, shopkeepers, at interest rates of 17 to 36% annually. India's credit opportunity is two stories running simultaneously. The first is substitution. A farmer paying 36% to a moneylender switching to a Kisan credit card at 12% is not new economic activity. But it is a new formal loan, cheaper, safer, and flowing through institutions that investors can own. The second is genuinely new demand. Investment that is not happening today because affordable credit simply does not exist for these borrowers. A small manufacturer who cannot borrow to buy equipment simply does not buy the equipment. When that changes, real new economic activity gets created. Every rupee that moves from informal to formal credit and every rupee of new credit unlocked creates earnings for the banks, NBFCs, and housing finance companies that investors can own. 3 structural barriers kept formal credit away from most of India. First, no financial history. Roughly 500 million workers in the informal economy have no payslip, no tax filing, no credit score. If a lender cannot see your financial life, it cannot price your risk. Second, nothing to pledge. Traditional bank loans require collateral, property or assets put up as security. Most small unregistered businesses have very little to offer. Without collateral, the loan does not happen under the old model. Third, the unit economics did not work. A 1 lakh rupees loan and a 10 crore rupees loan require almost the same credit assessment, legal checks, and ongoing monitoring, but the 1 lakh rupees loan generates a fraction of the interest income. For decades, banks rationally chose large borrowers. Small borrowers were left to the moneylender. All 3 of these barriers are now being dismantled by the same set of tools. The digital stack. 1. GST since 2017 gave millions of small businesses a formal, verifiable sales record for the first time. A trader's actual revenue now sits in a government database, visible to any lender who asks. 2. UPI, 100 billion transactions in FY25. A vendor collecting digital payments daily has 12 months of real cash flow data, already being used by lenders as a proxy for income assessment. 3. The account aggregator framework solves both the data problem and the cost problem simultaneously. Here is how it works today. Your bank statements, GST filings, tax returns, and investment records sit across different institutions. The account aggregator is an RBI-regulated digital pipe connecting all of them. When you apply for a loan, the lender sends a data request through this pipe. A consent screen appears on your phone, showing exactly what is being requested and for how long. Once you approve, your verified financial data flows instantly and encrypted to the lender. The account aggregator itself cannot read your data. It only passes it through. The result? What once took weeks of physical paperwork now takes seconds. And when the verification is automated, the economics of small loans changes completely. Digital lending costs 20 to 40% less to acquire and service than traditional branch-based lending. As of December 2025, over 2.6 billion financial accounts are enabled on this framework. The invisible economy is becoming visible. As of June 2026, the formal credit gap shows up most clearly in 02 segments, each with a distinct profile for investors. MSMEs, the largest gap. India has 6.3 crore registered small and medium businesses, contributing 30% of GDP and 46% of exports. SIDBI's May 2025 report estimates total debt demand from this sector at 92 lakh rupees crore. The gap, what the formal system could viably lend, is 30 lakh rupees crore. Higher potential return, but also higher risk. This is precisely where underwriting discipline separates quality lenders from the seeds of the next NPA cycle. Housing, the steadiest runway. Mortgage penetration in India sits at roughly 12% of GDP in 2026. China, a relevant comparison given its similar income trajectory, went from 12% in 2008 to 28% in 2017 as incomes rose. India is at that same starting point today, with urbanization adding new households at scale and a rate cut cycle improving affordability right now. Collateral-backed, long tenure, historically low NPAs. The steadiest segment in the lending universe. These two are not the same bet. Knowing which segment a lender is exposed to matters more than simply knowing it lends. India's credit story is not the simple deficit the headlines describe. It is a country where credit already exists, but is expensive, informal, and out of reach for too many people. However, the infrastructure to change that has finally been built. The opportunity is real. But so is the discipline required to capture it, without repeating the mistakes of the NPA crisis. The lenders that get both right, reaching the unreached and pricing risk honestly, will be among the most valuable businesses that India produces over the next 2 decades.